A fund is an investment strategy that pools together investors' money to purchase a range of securities. These can include stocks, bonds, gilts, commodities, property, other investment funds, ETFs, or CFDs, along with other investment strategies. Some funds may invest in all of these, and some may invest in one or two of these. They can also invest in a range of countries too. But again, some may only invest in just one country. A fund is not limited to the number of holdings within the fund. They could have one holding or thousands of holdings. All funds will have stock weightings within the fund. This shows what percentage of investors' money is put into a particular investment. Not all weightings are the same. It's at the fund manager's discretion. All funds are run by a fund manager. The job of the fund manager is to decide where investor money is invested and to run the fund's day-to-day operations. There are many different types of funds which you can invest in, including mutual funds, index funds, tracker funds, active managed, passive managed, and exchange-traded funds, ETFs, which we will discuss in another video. Mutual funds, also known as actively managed funds, are funds run by a fund manager who picks the specific investments within the fund with the aim to outperform a particular market. The investments or weighting can be changed at any time. These funds tend to have higher management charges, as the fund manager is more involved and has to pick the funds manually. The perks of this, it can be more diverse and invest in different markets, so if one market isn't performing well, the other investments may still perform okay. Index funds, also known as tracker or passive, are funds that will track a market. They tend to follow a market and invest in the same holdings within it. Take, for example, an S&P 500 tracker fund. This will track the 500 biggest companies in the USA and will invest in all the same companies listed on the S&P 500. These funds tend to have lower management charges due to the fund manager being less involved and not having to pick the investments. Some of these funds can track multiple markets or invest in funds that track multiple different markets. Many funds are either income or accumulation funds. For us to first understand this, we first need to understand what income we can earn from a fund. The two types of income are interest and dividends. This is significant if you hold your funds in a non-tax efficient, like an ISA or SIP account, as you may be liable for a different amount of tax on both. We will cover more on tax in another video. In the case of an income fund, the income that is earned is normally paid directly to the investor and usually credited to your investment account. From there, you can decide what you would like to do with that. Some investment platforms will allow you to reinvest that money, withdraw it, or hold it as cash. Income can be paid at different frequencies depending on the fund. An accumulation fund, on the other hand, is the income that is earned, is obtained within the fund, and is reinvested by the fund manager. This grows the value of the assets within the fund, over time, compounding and increasing the value of the fund. Most funds you buy will either be SICAV, OIEC, or unit trusts. These are the legal structures of the funds and show how the fund has been set up. These shouldn't affect how the fund performs, and neither is necessarily better than the other. Many funds will have a class in their name. These can vary from A to Z, numbers, or even more than one number or letter. A common misconception is that a fund which is a class, A fund, is better than a fund that may be a class Z, for example, because A is the first letter of the alphabet and Z is the last. But this is simply not true. The letter or number of the class determines the pricing structure of the fund. Each different class will have a different pricing structure. It also helps to differentiate between different funds with the same name. For the purposes of not making this video too long, I will link down below a website link that describes these in more detail about how charges are calculated for all the different classes. All funds will have charges associated with them. These are usually two charges, an initial charge, and an ongoing charge. There is also a third charge which you need to watch for, but we will discuss that shortly. The initial charge is a charge that you will pay at source when you purchase a fund. It is normally displayed in percentage form and is calculated in the price you pay for each unit of a fund. Not all funds will charge this, and some providers remove initial charges completely, but you need to check with your investment platform which funds charge these. The ongoing charge is a charge the fund manager charges for running the fund if the fund has made a loss or a gain. you will still be charged this. This charge is not something you will have to pay separately, or in addition to owning these funds. The ongoing charge is taken directly from within the fund, meaning the gain or loss displayed on your investments may have the ongoing charge taken from it. The third thing to look out for is a performance fee. This means if a fund performs in a certain way, you may have to pay more fees. Not many funds have this, but this is also taken from within the fund. Always look at the key investor information documents to find out if a fund will charge these. Another thing to consider when buying funds is dealing charges. Some platforms may charge you a fee to buy or sell funds, also known as a dealing fee, and some may charge you management fees for holdings investments on their platform. This is charged separately to your funds, so it may be worth checking with providers first. Remember before purchasing a fund to always check the Key Investor Information Document, or KIID, and the account report. This will tell you the purpose of the fund, what its aim is, and the risk level. The account report will have annual report statements and show a list of every holding within a fund. Unlike shares and equities, investment funds are not listed on a live market. This means that they're priced only once a day this time is different on every fund and is called the valuation point, which will be on the KIID. This can be good as their price doesn't fluctuate all the time, meaning they can be less volatile. The downside is that you don't always know the unit price at which you will be buying or selling a fund, so you could be buying or selling at a different price than originally intended. In the final part of this video, we are going to give an example as if you were looking at an investments on an investment platform. Let's say you had an example fund, Fund King Europe Class Z Monthly Income Fund. In this example, Fund King is the fund manager. The fund invests in Europe, it's a Class Z, and pays income monthly. So now you know what to look out for when investing in funds or looking at them online. Please remember that nothing in this video is financial advice. Thanks for watching. See you in the next video.